Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and today we're going to talk about 5 ways to insure your excess deposits. So most of you have heard of FDIC Insurance. This is the Federal Deposit Insurance Corporation, and it insures deposits at FDIC insured banks. This includes deposits placed in savings accounts, some money market accounts, checking accounts, and CDs. FDIC coverage ensures that your money's protected in the event of a bank failure. But there is a cap on the FDIC insurance limit and what it protects. So you may already know that the limit is $250,000 per depositor, but some additional rules also apply. If you maintain higher balances in your bank accounts, it's important to understand how much of your money falls under the FDIC insurance limit. Otherwise, some of your deposits could be at risk if your bank does indeed go belly up. The good news is there's different options for insuring excess deposits. So how much does FDIC insure? Currently, the FDIC insurance limit is $250,000 per depositor per insured bank for each account ownership category. And this is really important. We'll break this down. The FDIC recognizes these ownership categories when protecting deposits. So you have your single account holder, joint account, certain retirement accounts such as IRAs. We'll talk about that specifically in a second. Revocable and irrevocable trust account, employee benefit plan account, corporation, partnership, or unincorporated association account. And then you have government accounts on top of that. Single accounts are accounts owned by one person with no named beneficiaries. So for example, you may have a checking account and a savings account in your name only. Joint accounts have 2 or more owners, but no named beneficiaries. You might have a joint account or savings account with a spouse or even an aging parent. Eligible retirement accounts and trust accounts can have 1 or more beneficiaries attached to them. FDIC insurance extends to all deposit accounts at insured banks. This includes checking accounts, savings accounts, money market accounts, certificates of deposits or CDs, negotiable order of withdrawal accounts or NOW accounts, and official items issued by the bank, such as cashier's checks or money orders. So the FDIC insures these accounts, both the principal and interest, up to the specified limits. The FDIC does not insure stocks, bonds, mutual funds, life insurance policies, annuities, or municipal securities, even if you buy them at an FDIC insured bank. And this is where people get very, very confused because they will have IRAs at an FDIC insured bank, but they'll be invested in mutual funds. That is not covered under FDIC insurance. And a lot of people were under the misconception, whether they were led to believe that way or not, that those funds were indeed insured. Now, if you have your money in cash under IRA umbrella or in a CD or something that falls under the FDIC accounts that are insured, then that's protected if something were to happen to the bank. But if you have stocks, bonds, mutual funds within the IRA, even at an FDIC insured bank, those are not covered. So keep this in mind if you have those types of assets at the bank. So understand your coverage, your current coverage limits. Before you can insure excess deposits, it's important to know how much of your deposits are already protected. So for example, say you maintain single ownership of a checking account and a savings account at the same bank. You have $25,000 in checking and $275,000 in savings. According to the FDIC insurance per account rules, $50,000 of your money would not be covered. Okay. So now let's say you're married and you have the same checking and savings accounts, but you also have a joint savings account with your spouse with $500,000 balance. Under the FDIC insurance rules, you and your spouse would each have $250,000 in coverage in the joint account. So the entire account would be protected. But $50,000 of the money in your single ownership accounts would still be unprotected. If you have multiple accounts at the same financial institution, you can talk to a banker about which ones are protected up to the FDIC limit and how much you may have in excess deposits. You can also use the FDIC's electronic deposit insurance estimator to calculate your insurance coverage based on ownership category and account balance. This is a really key step so that you know what is in excess and what changes you might have to make. So how to insure excess deposits. The FDIC insurance limit applies to your accounts automatically, so long as your bank is FDIC insured. There's nothing special you need to do to qualify for it. But if you have $1 million or more in your accounts, are there banks that insure millions? And how much cash should you keep in the bank anyway? Here are some of the best ways to insure excess deposits above the FDIC limits. The first one is open new accounts at different banks. The simplest way to insure excess deposits above the $250,000 FDIC limit may be spreading the money around to different banks. Let's say you have $50,000 that's not insured at your current bank. You could deposit it into a savings or money market account at another bank, and it would be insured there. This does require a little research first to find the right bank. For example, if you're looking for savings accounts, you'd want to compare interest rates and fees at different banks. Online banks typically offer higher interest to savers and lower fees compared to traditional brick and mortar banks. Theoretically, you can insure $1 million or more by opening multiple accounts, maxing out your FDIC coverage limits. For instance, you could open 4 savings accounts at 4 different banks with $250,000 each. The trade-off, of course, is that keeping up with multiple accounts at different banks may not be ideal if you prefer a streamlined approach to money management. And I bring this up, most of my Fridays focus on finances come to fruition because of something that we're working on with a new client or existing client. And in this case, I was referred to a potential new client whose current advisor had them in 8 different banks. They had $2 million and they simply had them do $250,000 in 8 different banks, which by what I just spoke about is fine. And yes, the person is insured, but this is not necessarily the most efficient way for this client to spread their funds around. And how this even came about is that the client was going in for estate planning, and the estate planning attorney was helping them fund their trust and realized all the accounts that this client had. So part of the issue is they are in deposit accounts earning very little interest that the client's also being taxed on. So when we looking at financial planning from that scope, we want to look at a few things. How do we protect the funds, and how do we help them protect against the cost of living increases? So this person has a lot going on, and it doesn't need to be as complex. So keep in mind that you can have different categories under the same bank. So if you have an IRA, a CD, and let's say you're married, you have a joint account and a single account, then potentially you can insure $1,250,000 under the same umbrella, under the same bank. So that would simplify this person's situation much more than it is right now. The other issue is that had this estate planning attorney not accounted for all these accounts and they didn't have their trust set up properly, then those funds would go to probate if something happened to that client. So the second way to insure excess bank deposits is using CDARS. Certificates of deposit accounts can be really useful for saving towards longer term goals or potentially earning a higher interest rate than you would with a normal savings account. If you use CDs as a part of your savings strategy, it's possible to use them to work around FDIC insurance limits through SDARS. The Certificate of Deposit Account Registry Service represents a network of banks that insures millions for CD savers. Here's how it works. You sign a CDARS placement agreement and a custodial agreement, then invest money with that network member. This money is then divided into CDs by different CDARS banks. So theoretically, you can invest $5 million with CDARS and have it split into multiple CDs, each of which would be protected by the $250,000 FDIC insurance limits. This could be a good option if you're wondering where to find a bank that insures more than the 250,000 FDIC limit. But keep in mind that CDs are time deposits, meaning you agree to leave the funds alone until the CD matures. If you have to tap into any of your CDs before the maturity date, you could face an early withdrawal penalty. This is where staggering CDs comes in handy so that you're always having them mature at different times and having the funds available to you. Again, this is where financial planning comes in handy because you can actually see what's necessary and when you need those funds, whether for income or large purchase items. Number 3, you can consider moving some of your money to a credit union. Credit unions can offer a safe haven for excess bank accounts or bank deposits. While credit unions are not FDIC insured protected, they are still protected. The National Credit Union Administration, or NCUA, insures deposits up to $250,000 per depositor per credit union for each ownership category. You can share insurance estimator as well to determine how much of your deposits would be covered under this situation. Aside from making it possible to insure excess deposits, credit unions can offer some other perks as well. For instance, you may benefit from higher interest rates on deposit accounts and lower fees compared to traditional banks. You may also find that credit unions offer more favorable interest rates on different types of loans. If you're considering opening a credit union account, approach it the same way you would a bank account. That means comparing the fees you may pay and the interest you could earn, as well as other features such as online and mobile banking, access to different ATM networks and things of that nature. So you do want to do your due diligence, whether it's a regular bank or a credit union. The 4th way is to open a cash management account. Some brokerages and non-bank financial institutions offer access to cash management account. Cash management accounts can function like checking accounts, allowing you to spend or pay bills just as you would a traditional bank. But they can also be useful for insuring excess deposits. Cash management accounts that have a sweep feature allows deposits to be spread across multiple FDIC insured banks. For example, if you have $500,000 in your cash management account, the financial institution may spread it across 3 banks, sweeping $250,000 into one bank to account for any unpaid interest that could move your balance above the $250,000 FDIC insured protection limit. $245,000 to another and $10,000 into another final bank. This is done automatically for you, and your money is in one centralized location as far as use. This allows you to spread your money without losing FDIC insurance protections. Keep in mind that this benefit only extends to cash. Any securities you hold at a brokerage would be covered by the Securities Investor Protection Corporation, or SIPC, which insures against institutional failures. Number 5 is weighing other options. If you're specifically looking for banks that insure millions, you might consider an option like MaxSafe. MaxSafe allows depositors to increase their FDIC insurance limits from $250,000 to $3.75 million. That's 15 times higher than the current limit allowed for FDIC insurance per account. This works similarly to CDARS, though instead of putting money into CDs, you can spread it across money market accounts at 15 different institutions. There's a $1,000 minimum deposit required to get started, and there are no monthly maintenance fees or minimum balance requirements. The Depositors Insurance Fund, or DIF, is another option for insuring excess deposits. This program covers deposit account balances beyond $250,000 FDIC limits at member banks. So once you exhaust your FDIC insurance limits, you're still protected. There are no forms to fill out to take advantage of this coverage. You simply need to have accounts at a DIF member bank. So bottom line is bank failures, though rare, can happen. And when a bank fails, it's important to know that your money is safe. If you have deposits that exceed the FDIC limits, there are different ways to close the coverage gap. Knowing all possible options for insuring excess deposits can help you find a solution when FDIC protection falls short. And again, my example of the potential client that had her money spread over 8 banks, one of the things to consider in this scenario as well is that her money is not keeping up with purchasing power over time. And I just looked at the inflation rates. I think most of us have felt the increase of cost of goods like groceries and gasoline and things of that nature. And I looked and saw that the inflation rate as of December 2021 was 7%, if you can believe it. If you could also believe that's the highest inflation has been since June of 1982, and it was 6.8% at that point. So I want you to also remember, as much as protecting your principal is important, it's also to protect your purchasing power. So one of the things that we recommend is when you do your planning, you can see what do you need to hold in cash. Make sure all that is protected under the various ways that I spoke about today. But also don't make your money work so hard. So this client is in her early 50s and doesn't need the money for income. So not only is she getting less than 1% on average on all her funds, but she's losing purchasing power over time. So if she doesn't need the money for 10 years, her $2 million will not purchase $2 million worth of goods 10 years from now. So keep that in mind. There's ways to strategically look at your finances. Keep things protected, but don't miss out on opportunities to grow your wealth as well. If you want to know how these strategies might work for you, please visit our website at FlemingAssociatesLLC.com and schedule a complimentary discovery call. We would love to chat with you about your situation and see how we can help. Have a great weekend, everybody, and we'll see you next week on Friday's Focus on Finances.